What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming events, some upcoming earnings to get you prepared for the week ahead. That sounds like something you're interested in. Consider subscribing, as I do provide some Twitter comments every morning as well. So follow me at Hemi137 as I do provide commentary on what I currently feel the market, what's going on in the market as of during that day, as the market is dynamic and changes all the time. I will be also producing more videos here on the channel again. I was doing daily videos, but now I'm more focused on specific events currently going on. As of right now, the market is pretty quiet. Something I've talked about, if you followed me to this point, there is a lot of different things that have been going on, and we're kind of just watching for the drip drop of information that's coming out that's kind of essentially painting the rest of the picture. Something I've talked about in the beginning of the year, what we were looking for is inflation to come down, where we're looking for phase two on interest rates, which was a pause, and then we would slowly gather into that pricing in of a recession, which is phase three. And then that would essentially expecting a big boom cycle after this. Although, despite everything that's going on, it is a really horrible time, and interest rate hiking is not a pretty picture when it is. When that process is going through its cycle. And understand, this is a process. This is a normal process. This happens all the time. This happens on a debt-based system, and a lot of people will get harmed essentially when this cycle is going through, and a lot of people will lose a lot in these cycles. But this also is a great time to reflect and build, and to be taking advantage of this time, because we are going to get some very deep discounted rates that you will not see, but every cycle, which every cycle could take about a decade or so for it to occur, just all depending. And despite the massive money printing, it does make these cycles a lot bigger when they do occur. So with that being said, let's take a recap of what's going on over the past week. As I said, the next this past week was big. We had the big core CPI, or not core, but we had monetary policy come out. We had the dot plot come out. We had Powell come and speak a little bit. He gave a lot of insight into what's going to occur for the rest of the year, kind of going into next year. So despite that being said, after that, we're pretty much quiet until the 13th of next month, which we start getting earnings again. So the past week, like I said, we had the interest rate decision was pause on the rate hikes. And so that gives us essentially about 2 months that we've been sitting with a pause. So is this officially a pause? And with the way things are kind of looking, it looks like it could be, although 12 Fed members are saying that there could be one more rate hike. Powell kind of alluded to possibly one more, but we will see. Now, it's kind of gauged for November being that next monetary policy rate increase. It really just depends. And there's a lot playing into this. This is something I've talked about too, is what's been going on behind closed doors. And you have to understand the major impact that essentially oil has on our economy. Despite people trying to get off of it, that we use oil for so many different things, not just filling up your cars. So with that being said, we depleted a lot of our reserves, which drove down the price when inflation was up at 9%, and then driving it back down to where it currently is. Now we're having problems because we don't have the reserve to be able to do that again. And we were talking about buying more oil to do the same thing again, to drive down inflation. But until then, we are seeing an uptick in inflation, again, primarily led by gasoline. And understand that gasoline affects food prices. It affects essentially anything that has to be transported, which is pretty much everything. And so with that being said, you're going to see those prices start to increase, and they're projecting it to go well over 100. And so that is a problem, and something I talked about is inflation. We weren't concerned about inflation because it was coming down, but now the problem is if they don't get those reserves filled back up and start releasing that oil again, we could see some big problems again. We see inflation come roaring back, and that could be a huge problem, which the Fed would have to potentially raise rates even more. And so that is the concern. So with that being said, we came into this year, and something I talked about, we came into this year, the back half of this year, that we would have 4 rate cuts. That is essentially been changed about 6 months in, and changed even more to where rate cuts, they initially said when they were coming out, Powell had initially said that, or not Powell himself, but the projections were essentially saying September of next year when we start getting rate cuts. Now they moved it up to July. And this is something they did with these rate cuts keep jumping around, so you can't go off of strictly what that is, and you can't go off of what the Fed's saying, that we're going to essentially be in a quote unquote recession at the back half of next year. Again, they're going to project these things out because I think they're feeling like we are really close for something major to be happening, and especially if we're pausing now, that would mean we were getting ready to start pricing in a recession. And Powell alluded to a lot of these different things and essentially said that we'd be lucky if we hit a soft landing pretty much at this point. And so that was new from Powell. And with that being said, ultimately, everything else was kind of in line with him. It was all data dependent, but obviously he's not going to come out. He doesn't want people to time this thing. He has to give a very foggy outlook because, again, it is data dependent. It depends on a lot of different aspects. It's not just one particular data point or anything like that. It depends. So it depends on what happens with the banks, the businesses, the people, right? Depends what happens with inflation, right? There's a lot of different things that come into play that you can't just base it solely off of one particular thing. So it's essentially gathering those metrics and coming up with essentially a conclusion off of all those metrics combined. So with that being said, again, very interesting spot we're put in. The market started selling pretty heavy this week, which is good to see. Finally, some movement. We might actually start pricing in a recession at this point. We will see. We have to see how we open this week. Again, we're going to go into a week where there's not hardly any news unless some new news comes out. Again, no scheduled news. That's not saying if no news comes out that it can't move the market. If there's any news out here that is not scheduled, can drop and could correct the market. But again, what we've seen and what the pattern has been is that all big major news is essentially held off till earnings. So again, Q3 earnings is something I've talked about is going to be a big catalyst for what could be pricing in a recession. And again, we are just a week away from student loan repayment. People who can't afford an additional, because on average it's about 300, 350, I think is what student loan repayment is. People can't afford that at all. They can't afford a $400 emergency payment. Now you're adding all that in to millions of Americans who now have to pay that, who haven't paid that for a couple of years now. And so, being said, it is going to be a big problem moving forward. And so, again, October could be a really dark black month. It could be the month that we are priced in a recession. Again, we go by probabilities, and by the probability of that happening is very high coming into October. We also have something I didn't mention here, but we do have the debts. Not the debt ceiling, but the annual budget and government shutdown being talked about a lot. Now, originally, it doesn't do anything to the market, but I wasn't thinking about this before, but it had just come to me the past couple of days. A lot of government employees just won't be working unless they're emergency personnel. Contractors, absolutely. Contractors essentially get shafted because of the fact that they won't get back paid, where government employees will get back paid for the amount of time that they're out. But being said, what is going to happen is that reports, the data metrics that we are getting, what happens if we don't get those? It's kind of funny how this is all playing out, and maybe those reports, those extremely important reports that are supposed to be showing recessionary type numbers, maybe this is when it's supposed to happen and the government shut down. So you're not going to get those reports, or you're going to get a very delayed reports on those. And so that being said, that could be what it is. That could be the catalyst that it is that could drive us down. So when you want to talk about probabilities, the probability of October being a very dark month, it can happen. And then you got the banks coming up, you got bank earnings coming up, strategic place on a Friday, and you got other earnings that are coming up. Apple dealing with all the China stuff. And being banned. All right, we're going to see more impact of that. Hold 7% of the essentially again um, essentially the stock market, the index. So we have to be mindful of all these things. And so, again, all the things I've talked about, I think to this point, may start to unravel as we go into October. With that being said, the average interest rate for a 30-year fixed mortgage raises to 7.75. So it's climbing up. And again, we may see 10%. It could be a strong possibility. Also, mortgage applications are at like 25-year lows. So it's nothing is moving. There's no liquidity, and this is a huge problem. Even with all these 1% down, they're trying to get somebody to buy so that way they can keep liquidity going, get this cash flow going. But the engine is seizing up, and this is what Powell kind of had a little bit of like hope uh, in his voice when he was talking that what they're doing is actually starting to work and they're seeing the progress of that. So you could see that, you can see him lighten up that it's finally like it's happening, that what them quantitative tightening is actually doing what it's supposed to be doing. So you could see that, him highlight that when he was talking about it over this last monetary policy. So it's just holding the rates here at this point for things to start coming down quite a bit. So again, I think we are really close. And again, I will always like to bring up the Bitcoin spot ETF that's supposed to be approved by March. Bitcoin halving is right around the corner as well. And again, I think institutions are sitting on a lot of money. So if they can get their last dip, which we are sitting in the fear, if you want to look at the fear gauge for the market when it comes to crypto, they're sitting roughly around in the fear gauge. So we're not at extreme fear yet, but I do believe at this point, again, we haven't priced in recession or full recession from the peak to the trough, whatever that is about on average 42%. Again, pointing us roughly around that 32 mark, 3200 mark for the SPX. So I don't know if we'll go make new lows, but again, it all depends on timing and momentum of what happens in the fear that's in the markets again, and then the market's going to price in a recession, and then I believe we'll have a huge boom cycle, but we don't know how low we can go. Again, 40% of the money supply, a very historic time. It does rhyme for the most part, but again, we don't know how volatile it's going to be. Again, the world was always ending on every 2008, when all these crises that we've had, these stock market crashes, the world was always going to end and we always found a way out. So just be mindful of that. And so don't let the fear drive you to not be able to invest something. Now is again a great time, not financial advice, to take advantage of this dip. This was the dip I am talking about. So I will be, again, not financial advice, be buying on the dips on specific stocks that I believe will do extremely well in the current environment. Again, you have to understand the stock market will make the move and recover way before housing and everything else will recover. Housing will have a longer time and housing will crash over the next couple years. Understand as these loans come to maturity and people start losing their jobs, that pool that people are trying to make you to buy, it's just not going to happen because there will be no demand there. All right. Powell is killing demand. You have to understand that it's going to take a while for people to recover and feel safe to start investing again or purchasing a home or be in that position to be able to do that. So just keep that in mind. So with that being said, core PCE this week, we really don't got a lot. We have some Fed members talking. Some Fed members might hold a little bit more weight this week, only because of the fact of post Powell right now. So you got a little bit of that sensitivity mark. Again, talking about recession, talking about a really hard recession. could be something we hear about. Again, they're trying to kind of dilute a lot of the message that's going out there, just to, again, you don't want to throw a frog in boiling water because it will jump straight out, right? You want to slowly raise the temperature of that water to be able to boil a frog. So to be able to do that, they're kind of slowly conditioning the market to think that, yeah, it's going to be just mild, it's going to be a soft landing, and then, oh man, it's a dark, deep dark recession, it's a depression. So again, being said, we will see. So we'll have a couple of Fed members talking this week. We got core PCE hold a little bit of weight, intraday weight on Friday at 2 p.m. Eastern Standard Time. Again, a lot of these different data sets are positioned, which they normally aren't positioned differently, but considering what's going on with the market sentiment, they shift things around to adjust in case something bad happens. Releases on Friday, they can take it in the weekend and address it. Instead, if the market starts crashing on Friday, they got a couple days to try to, again, butter everybody up and try to get the market to recover over the weekend if necessary. So upcoming events, monetary policy. Again, the next monetary policy is until November 1st. We got a long time before then. The next core is on October 12th. Again, going to be important, as I think we're going to see more of an uptick, especially with fuel pushing up, that October is going to be a really nasty, bad report in general. So you're going to get not only the next core, but you're going to get bank earnings, a lot of more bank closures, I'm sure, and failures. So big things to keep in mind. Again, upcoming earnings that Friday, October 13th. So you're going to have core, and then, like I said, earnings right back behind that with JPM, Citibank, and Wells Fargo. And then watch list. This is something I'm talking about. The market is starting to see that it's potentially getting ready to price in a recession. There is no major event yet. SPX is starting to climb because of the events, the Powell projections. SPX has jumped up about, I believe it's about 20 points since last week. Tesla itself has jumped up is slowly creeping up. Tesla's roughly around like 10, 11. So it's slowly starting to push up. BA is pushing up. For BA and JPM to push up, that means there's a bigger event that they're expecting. And you're starting to see that uptick of 1 point for JPM and BA. So that means that they're expecting more of a move this week than anticipated. So again, SPX is okay to play this week, but just know that you get a bigger bang for your buck if you play single stocks this week. And again, depending on those stocks, now your Teslas and some of your other ones like NVIDIA and stuff will potentially move a lot more given the circumstances. Also understand you to look at your baseline. We are in earnings mode from now until when the company actually reports. You are in earnings mode, so you might get a lot of dumps and pumps going into earnings. So just keep that in mind, especially in the Big Seven. Big Seven will have big movements between now and when they actually report. So always keep that in mind. These are things I look at and why I pay attention to this list on options. To see what my baseline is. If you have a baseline, then it's easier to make a decision on what to be playing and what not to be playing, or just be sitting out, because not being in a position is also a position, especially in a market like this. So now that being said, let's look at some charts here coming into this week. Again, not expecting much. The market is expecting a bigger move this week, especially giving what we got going on with post Powell and everything, and that dot plot. Again, if we are officially paused, he tried to again mask if we were paused, but considering we're going potentially another month before that happens, the odds of a rate hike for November have come down quite substantially. It dropped about 20%. So I think we're sitting roughly around 30% compared to a 50% like we were before. So they're not, I think they're saying this might be the official pause. We're 2 months in and the market's already priced in essentially that pause. So it's moved up. We've seen that over the past couple months. Now we could be looking at pricing in a recession, and that's what we're looking for. Again, any signs of that, this is why price action means a lot, because we start getting some major selling, especially this week with no real big news. That could be the sign that we're going to just go ahead and price in recession now. So again, we want to be watching this 4,300 level. I think we're at least going to get down to 4,200. Again, the 4,200 would kind of, I think, put us preparing for earnings, preparing for essentially what really bad can come in October. So if we start really selling heavy this week, 4,200 is my mark that I'm watching. If we do hit that, we will get a pretty nice bounce off that, and then we'll see if we continue selling down. Again, your peak here is around 4,600. We attempted. This is like any major run up, is what you'll get as a major run up, and you'll find if eventually you'll find a top on that run up, and then you'll get a pullback and one last retest before the dump. Now, something I've talked about up to this point is that we had all this chop. You get a break, and then that's typically the liquidity you need, and then this thing just dumps. Again, we were only about 200 points away from all-time highs again. We will see. The market really needs to hold that 4,200 level. That is the key level. If the market comes down to 4,200, it needs to hold that level. You're going to get a nice bounce off of it. But if it doesn't, that means I think we could be going for a potentially new low. And if you look at any of these in history, a lot of any of these major pullbacks, you've always had major sell-off, then you've had a bump, especially like during COVID. You had this major dump. You have a major push up. We were only like 200 points away back to all-time highs, and then we just dumped. And then we came ripping back. So essentially that 1 month candle, whole 1 month, we got massive limit downs. Now, recession is different. You're not going to get massive just limit downs or anything like that. You're going to get a slow crash. So this might be maybe a couple candles as opposed to just a whole month crash, even like in 2008, right? You look back at 2008 here. In the 2008 crash, you had a couple months of just down. And I think that's what we're going to get here. Obviously, the more money printing, that's why we get this move. So the more money printing, you get bigger moves. This was left field black swan event. That's a black swan event. That's what happened there. But 40% of the money supply printed. I think we'll get a couple months of just down. We'll see if we can get. It's not saying we'll hit 4,200. Again, I think you got really key levels here. Like I said, the 4,200, we break that. Again, then your next big level is, again, the low that we hit around that 3,600 to see if we hit that. But again, we'll see. Again, we are pricing in a recession. We need prices to normalize is what we need. And so once that does happen, then I think we'll get a big boom cycle out of this. And that's what happens when you look back again at 2008, you get massive selling. Then you get a boom. The boom cycle isn't like this. This is not what we're talking about. This is printing 40% of the money side. The boom cycle is like this. You gradually start getting a nice push up because at this point, you've reset the clock, right? And this is what we're talking about, the cycles that need to occur. You reset the clock, so you destroy essentially all demand, and then you wait for demand to come back. You don't want demand rushing back in. And so this is what happens. You get this massive crater, and then you slowly, gradually start getting confidence back, and the market starts ripping for a good 10 years. And then you get a hard reset, and then that's pretty much how that works, right? It happens every about decade or so. And we haven't had one for obviously long. If you've seen this, we haven't had one for a very long time. So we were due for one, but we had the black swan event that kind of just corrected, and we again printed 40% of the money supply to save that. So again, I do expect the same kind of movement here. Again, it's going to be bigger here because you have more of a money supply. If you have to look at what 40% of the money supply looks like, again, this move right here is 40% of the money supply. So again, what you should be expecting, and again, my approach to this is to look at the best 7 stocks, and crypto is going. So all innovative stocks in all crypto, I think, are going to be huge on this boom cycle like this. I think they're going to drive and lead the market. Now, this is the index is slowly going to grind. So once we normalize, expect a nice grind and move like this for the next 10 years, right? That's not saying things aren't going to change. Things will change a lot because of everything that's going on with BRICS and everything like that. But again, once we get that normalization, then we start slowly grinding back up, and you have a nice smooth growth line is what we're looking for, not this straight up because of a black swan event. So you have to, if you took out the black swan event, essentially the market would just naturally have grinded up to potentially right where we're at right now. If this event didn't occur, right, we probably would just naturally grind it up. We would have reset anyway. We were looking bad here before the pandemic. It was just the pandemic forced the money supply printing. So that's what caused this move here. So now that we've kind of gradually hit that, now we price in a recession, maybe come down a little bit lower, maybe we roughly hit around that 3,500, and then we bounce around there, and then we start getting again this nice gradual move potentially onto here, start getting back to all-time highs for the market in general. So again, but this whole system is a debt-based system. We need to we have to keep creating money for the system to work. So how money comes into existence is by borrowing, or else that money doesn't exist. If every dollar was paid back, there wouldn't be a dollar, right? There would be no value in a dollar if every dollar was paid back. So just keep that in mind. So that's what we're looking for there, and kind of what I'm expecting. I wanted to kind of make this video more so gain towards that as the move I believe is starting to occur. Our recession price and move is potentially starting to occur. Now Bitcoin, again, I think it will have one last pullback. Will we reach the 16K mark? I don't know. Again, high or low here. So your high is up here. Your highest high is up here. So we could roll over and drop again. Below this, again, I think anything below this is going to be short-lived. And I think institutional buying is roughly around somewhere around here. This is why I like zones, because you can kind of see where that's going to happen. So as of right now, we know roughly around that 16K mark. There are some buyers there. There could be some big buyers roughly around here. See how all this right here, before this big boom cycle, you had a lot of consolidation right here. So I think institutions are kind of hovering around that 10K mark. So if this thing gets anywhere near here, you can almost guarantee that you're going to get a bunch of institutional buying, which could potentially lead into a big boom in 2024 for looking into Bitcoin having spot ETF. Once spot ETF gets approved, you're going to get massive buying and a huge flood of money that could potentially send this to all-time highs very quickly. So again, you have the little boom. You even see it here. You get the boom, pull back, and then kind of grind. We'll see we get another drop here and then kind of grind. So really watching that 10K mark for crypto. And then again, buying as much on this dip. I'm buying as much as I can of everything, and then we'll go from there and have an extent that in the next 2 to 3 years, the markets will recover, but ultimately understand that the economy in itself is going to be a slow grind back up, and I showed that on SPX and how slow that is. But it's a nice smooth curve and not just vertical or straight up or straight down. That once you normalize, then it's getting that confidence back, and that takes a while. Once you destroy everything, it takes a while to rebuild and start building it back up. This is the debt-based system and how it works. And so SPX or Tesla. This is one I want to kind of go over some ones that I'm looking for on the dip, Tesla being one of them. So kind of really just highlighting some key dip points here, one being around the 206 mark, and then a big one obviously being around the 100 mark. There are some other potential buy points here, roughly around the 170. Could actually make that another one as well here. See, these are all buy points potentially on the downside here, and then obviously anything down here, Tesla could potentially even get to 50 if it gets that nasty. It really depends on timing. You can't say anything's out of perspective, especially when you're pricing in a very historic recession right now. Again, like I said, you have more money in the system. You're going to get bigger moves. And so with that being said, we will see how this thing plays out. But I think once it breaks, if it can break this uptick here, As you can see, that it happens back here as well, and you get a bigger move down. So we'll see if we'll get a bigger move down to the 100. Again, very popular stock and recovers very quickly, has a lot of good potential and a lot of AI. So I want to keep Tesla on. It's not just cars, it's energy, it's AI. There's a lot of different things that Tesla is doing. They're building robots. They're doing a lot of other things outside of just cars. I think cars will suffer, but I think it's going to be that shift in the company that's going to cause them to be massive in AI and everything else. And so again, they're buying a lot of NVIDIA chips as well. So these are the levels I'm watching. I try to highlight them all here and have price points so you can kind of see those clearly on what I'm looking at, my buy points on this way down as we start going. Again, this thing could get really nasty very fast. We don't know how big or how bad it can be. I can assume it can go to a new low, but we don't know that. So at this point, again, not financial advice, but these are the price points I am watching. Palantir, again, another big one I am watching on the way down. One price point I've hit. I've taken a position in this already, but willing to buy at these other price points around the 10, 1030. And then again, roughly around that 628 mark. Again, I think then we run in, once we get past some of these bigger moves, I think we're going to run into a war as well. So I think cybersecurity is going to be big. Going in the next future years. And so that being said, I don't think it's going to be a straight out like war kind of thing. It's going to be more like a Cold War kind of thing, which I think we're starting to see with the NVIDIA stuff and the theory I've had about that, about potential bumping numbers with NVIDIA numbers just to kind of potentially scare China to try to hurry up and do something, much like some other potential conspiracy theories out there. But I think that it's very true. These things happen. They're not conspiracy theories, but they are very much true, and we do it to scare off or to show strength, especially during a time of weakness. You want something to show strength, and so we will see there. But so watching that UPS ST is another one. This one I do want to be careful with this one because of just the current sentiment with the banks, and this one being essentially loans. It does everything through AI as well, but I think they do lead much in that cat. SoFi could be another one of those as well. But this one here, again, I want to take a small position in this. I don't want to go crazy on this, but I do want to get a position in this, especially when it starts getting roughly around that $10 mark again, which is coming down pretty quick. So I am watching this, and we'll potentially start grabbing roughly around that 10 mark as well if we do reach that far. Apple, I'm going to bring this one up. I'm not buying this one. I think Apple's going to suffer pretty heavy in this one. And looking forward, I think it's still a great stock to have, not at the price it's at. Obviously, I think it really needs to get way down here, again, down to this 125 level before even considering Apple again. But again, we will see. Again, it's a well-known brand, but I think it might start losing some of its pizzazz, just depending on what happens going forward. Again, times like this is where, but they do have a lot of cash on hand, so you have to keep that in mind. But I think even Google could potentially be a big one, especially with AI. This is a ascending wedge you got to be watching out for. So it looks like we've already broke that. So this thing, if it stays below 129, this could get a huge drop, 75, roughly around 75%. So kind of aiming for the 104. If we start selling off heavy, this could be a great short. So potentially watching that for this week as well. We'll see what happens there. Let's take a look at BA. BA again. Break this back down to the daily. Again, we've broken out, got liquidity. Now we got back into that range, and we are toying with 190. Again, this holds a lot of weight for value, and so you're starting to see value sell off heavily. We'll see if it can hold the 190. If it breaks 190, I think the rest of the market's going to go with it. I've talked about this before. A lot of these talked about filling gaps, and a lot of times you don't get all these gap fills. Like you had this massive rip, and none of this was tested. This 166 wasn't tested. I do believe we'll at least see 166, if not lower than that. So 166 is the key level I'm watching on BA. I'm not a big fan of BA. I just bring it up to show for value. I've kind of gone over the ones I am really looking at over the next couple over the next month if we do get a big dip. So now these are just more gauged toward what we're watching in value and banks, like I do all the time every week. So, and then JP Morgan, we'll see. It needs to hold roughly this 140 mark. It breaks that. Again, these are all the key levels. It needs to fill this gap, I think, still at the 125. So watching that, and then you still have this huge gap here, which it hasn't filled yet. We start pricing in a recession, losing a lot of banks. This is something else that was brought up, was that banks were threatened to be downgraded, or some of our big 10 banks. Now, with this next cycle, I would not be surprised if we see not only more bank failures, but we start seeing our Big 10 banks downgraded. Again, if that happens, it could be very much a possibility that this does fill this gap, and we may see another 100 JPM at 100. But again, we don't know if that's going to happen, if that's going to occur. DCAing from this point for the next couple months could be a strong possibility, just depending on what's happening. And just be mindful that if you do DCA, it's a more of a long-term strategy than just I take advantage both long-term and short-term plays. I play a wide variety of different things. So that being said, but I do believe if you are an investor, this is definitely the dip to be buying. Again, not financial advice, but because there's a lot. I think this will be the correction, and then I think we will have a nice boom cycle, like I showed you, over the next 5 to 10 years after that, where you'll have nice progression, and it will be led by AI, and it will be led by crypto. And so those are the kind of things that I'm watching going into this potential new bull run. But again, we got to get through that big event. So we got to get price into recession, and then we go from there. So with all that being said, I do appreciate you. Go ahead and drop a like if you enjoy this video, and share the video out. Just get the message out to everybody else out there. And until next time, I'll see you guys later.